The theory that all publicly available information is already reflected in stock prices is known as the efficient market hypothesis, and it has huge implications for how you should invest as a personal investor. This week, I'm going to explain it in super simple terms and also explain what it might mean for you. For those of you that don't know me, I'm the fireman, and I'm trying to reach financial independence before I turn 30 years old. And I've said before on this channel that investing is an absolutely critical part of reaching that milestone. Unfortunately, investing can be complicated, and there's going to be a lot of individual factors that will influence how you should personally invest. But something that might be helpful to know about is the efficient market hypothesis. Okay, so what is the efficient market hypothesis? Well, the efficient market hypothesis is the idea that large stock market exchanges like NASDAQ or the most famous one, the New York Stock Exchange, are efficient markets. Now, what is an efficient market? An efficient market is a market where prices adjust quickly and accurately to new information. So all currently available information is reflected in the prices of what's ever being traded on the market. In other words, the efficient market hypothesis claims that everything traded on the market is fairly priced. Let's get a little deeper. See, there are three types of efficient markets, and the first one is a weak form efficient market. In a weak form efficient market, the price of a stock reflects all information about its historical prices. And let me make that a little more clear. What that means is understanding the past prices of a stock doesn't tell you what it'll be in the future. In other words, how the stock went up and down in value in days past doesn't tell you anything about how that stock is going to trade today or tomorrow. This might not sound like a bold claim, but there are a ton of investors using what's called technical analysis to try to predict stock movements. This technical analysis entails looking at momentum or other patterns of a stock price to see how that company might go up or down in value depending on what's been happening recently. In a weak form efficient market, this strategy isn't useful. Because these changes are somewhat random compared to past days, you can't profit off of this information. Let's move on to the second type of efficient market, which is a semi-strong form efficient market. In a semi-strong form efficient market, all publicly available knowledge is reflected in the stock price. So even if you knew everything there was to know about a stock, you wouldn't be able to profit off of that. In a semi-strong form efficient market, the only way to consistently beat the market and profit off of your knowledge is through insider trading, which, if you weren't aware, is illegal. That leads us to the third form of an efficient market, which is a strong form efficient market. In a strong form efficient market, even insider information is reflected in the stock market. So that means there's no information that would give you an edge over any other investor. In other words, every single stock would be priced fairly. So are markets really efficient? Well, sort of. There have been cases of insider information giving some people an edge when they're investing. So I definitely wouldn't argue that the stock market is strong form efficient. But attempts to beat the stock market using publicly available or historical information have, for the most part, failed. Given that, I treat the stock market as semi strong form efficient. And of course, somebody is going to profit off of breaking news and new adjustments to the stock market, but that happens so quickly that it's really hard for an investor like me to actually profit off of it. So, what does the efficient market hypothesis mean for individual investors like you and me? Well, let me tell you a quick story to illustrate. When I was in college, I was briefly in investment club. And in this club, we ran a simulation to see who could have a higher stock market return, but we weren't using real money. During one of the meetings, the club president advised everybody to invest in Apple stock. See, according to his reasoning, Apple stock always jumped after quarterly reports. And with a quarterly report coming up, he was expecting to make a quick buck. This is a classic attempt at trying to profit off of historical information. See, if Apple stock has consistently jumped after quarterly reports, that means that Apple has consistently beaten market expectations each quarter. And that's a very impressive feat. That particular quarter, the market expectations were just too high. Apple reported good news, but it wasn't enough, and the market price of Apple dropped. The club president lost a lot of his initial investment. So even though Apple reported good news, it wasn't better news than what the market expected, so the price still adjusted downwards. So if the efficient market hypothesis is true, then beating the stock market as an individual investor is immensely difficult, maybe even impossible. The market responds so quickly to new information that to beat the market, you would need either dumb luck or insider information. Now, I'm not a financial advisor, and I'm definitely not your financial advisor. Investing will always carry some risk, and how you invest will depend on a lot of factors. Still, no matter what position you're in, I'm really hoping this video helped you understand the efficient market hypothesis a little better and helps you invest your money a little more wisely. One of the reasons that understanding investing and market returns is so important is it helps you calculate when you'll reach financial freedom. And there's a lot of calculators that will help you do this on the internet, and some of them are created by super reputable banks and investment firms. But unfortunately, as I explained in this video, most of them are terrible. There are a few massive errors that almost all of these calculators make, and understanding them might help you plan for and reach financial freedom much faster. So I hope you'll check that video out next, and if you liked this one, smash the like button. Thanks so much, I'll see you next time.